everyone, welcome to BQ Prime. I'm Hiraldaria. One stock that's in focus today is Mahindra Holidays and Resorts India on the back of the Q3 numbers that they have announced. Joining us on the show to discuss the same is Mr. Kavinder Singh, MD and CEO. Welcome to the show, Kavinder, and always a pleasure to speak to you, and a very good morning.
Good morning.
Kavinder, my first question coming to you is overall, if you see in terms of the numbers, in terms of analyst estimates as well as above what the street was estimating, have the numbers met your internal expectations?
Yeah, actually, this quarter turned out to be the best ever quarter for us. If you look at our standalone performance, our resort income grew by 30% on YOY basis. Our total income grew by about 18%. Our EBITDA and PBT both grew by about 17% on YOY basis. Even if you look at a consolidated level, our PBT in the quarter 3 went up almost 104%, almost double. And if I were to look at 9-month performance as well, at a consolidated level, we were up, our PBT is up by about 91%. So all in all, and these are all excluding the one-offs, and the one-offs are in the nature of some forex movements that have happened. As you know, that INR has depreciated against Euro by about 10% in the last few months. And therefore, you will see these one-off forex, which we have explained well in our investor presentation also, that these movements are non-cash in nature. And these movements led to, seeing a number at the consolidated level, which is appearing to be negative. But if you look at the operating level performance, which I alluded earlier, our consolidated level profit before tax is actually doubled. So, and if I were to look at some operating matrices, our occupancy was at about 85%. And this is on the back of adding about 1,000 rooms in the last 2 years during the pandemic. So even with the expanded room inventory of roughly about 4,800 rooms, we have seen our occupancy stable at 85%. By the way, January also is looking very good, closed at about 86%. As you know, we open the bookings 4 months in advance. So we are looking at very good numbers in Feb and March in terms of occupancies as well. So all in all, turned out to be a great quarter. Even if I were to see the member additions grew by about 13% YOY basis. And if I were to look at the value-based sales, value sales of our member additions, that turned out to be 19% up. And most important, which I would like to highlight, is that our upgrades have shown a very big momentum. And we are now seeing upgrades actually going up. And in fact, upgrades alone grew by about 23% on a year-on-year basis. And we added 80 rooms this quarter. We added 4 resorts to our portfolio. So it is, all in all, a very, very good quarter. And that is something that, of course, it has beaten analyst estimates. And we are very happy with the quarter performance.
Right. So overall, that's on a standalone basis. Now, if you have to club it and talk about the consolidated numbers, overall, it is a loss number coming in there. And I'm sure it's because of holiday club resorts as well. If you can just elaborate on that front.
So actually, the negative number that you talk at the consolidated level is actually not because of the performance of Holiday Club. It is largely because of the forex movements that have happened. As I mentioned, we have a loan in overseas subsidiary. This is a euro loan. And when these INR depreciated against the euro by 10%, so there is a mark-to-market movement. These are non-cash charges. And that have affected the PAT number which you are referring to. But if I were to look at a simple consolidated PBT number, and if I were to compare on a YOY basis, we have doubled our profit before tax, even at a consolidated level. And on a 9-month basis also, not just this quarter, we are up by 91% on the PBT.
Right. And from here on, from a business perspective, as you mentioned, in terms of occupancies as well, where we are seeing good growth coming in on the back of the pre-bookings. But overall, from a travel industry perspective, the way things have opened up, how are we as compared to pre-COVID levels now?
So if I were to look at pre-COVID levels, 2-3 inputs I can give you very, very quickly. First of all, we are far better than pre-COVID levels if you were to look at our margins. We have actually improved our EBITDA margins. Our EBITDA is at about 29.4%. And this is a 500 bips improvement over the pre-COVID level of the same period. And if I were to look at even at a 9-month level, our EBITDA is about 28.3%. and that is also up by about 300 basis points over 9 months period, which is pre-pandemic. So margins are up significantly over pre-pandemic. Of course, our profit before tax is significantly up by about 55%. So if I were to look at comparison to the pre-pandemic levels, I would say that we are far better than the pre-pandemic levels, both in terms of margins, our income, because our resort incomes have grown significantly. Even on a 9-month basis, our resort income on YOY basis moved up by about 80%. So all in all, we have crossed the pre-pandemic income, profit before tax, EBITDA, margins, as well as the occupied room nights, because we today have 1,000 rooms more than what we had during the pandemic times.
Right. And from a margin perspective as well, overall, we've seen a margin of around 35%. If you see in terms of the margin excluding one-offs, it's around 29.3% as well. What's the range that we look to maintain going ahead?
So, you know that in a business like ours, when we don't even get the room rentals because the rooms are prepaid by the members, a margin of about 29% EBITDA is a very healthy margin. And it is something that we would like to maintain and grow as we move forward. And you would appreciate that in these inflationary times, it will require us to constantly adjust prices if need be, also save on cost. Just to let you know the pricing actions that we took and the cost saving actions that we have taken. On the pricing side, we have increased our prices slightly on the F&B side, as well as our membership prices have gone up 2 times, April and November. But parallelly, we have added our 22 resorts are currently solar powered, not fully though. Our aim is to get 40% of our energy requirements from solar. So there's a lot of solarization going on. There are a lot of initiatives that are being taken for conservation, which includes water conservation as well. 58% of our water is recycled in our resorts. Even today, we have saved 750 million liters of water. So our philosophy of sustainability and overall cost saving actions that we have taken, as I mentioned on the energy side, including energy saving measures, and of course, various other actions that we routinely take, along with the price increases that we do, which are very minor, have helped us to maintain margins and grow margins. And most importantly, these upgrades help us a lot. And just to let you know, our cash, operating cash stood at about 377 crores during this quarter. And if I were to compare it against the previous quarter YOY basis, that was at about 252 crores. So 25% growth in even the operating cash flows. And our cash position is now at 1089 crores, which moved up by 70 crores.
Right. So overall, if you see in terms of where, in terms of key additions goes, right? Our target is that inventory additions to the tune of almost 5,500 plus rooms by FY25 is what we are aiming. Are we on track, or do you think we will exceed that number?
So as of now, I can say we are definitely on track to hit that number. We might exceed that number as well. There are plans to exceed that number. So we are tracking very well. And if I were to just say that there are 3 projects which are under construction, which are right now going on, which will add about something like 350 rooms. There are another 3 projects that will get going in the next few months. That will add another 350 rooms over the next 2 to 3 years. We are also looking at acquisition of few resorts. And our idea would be to add approximately 1,500 to 1,800 rooms with an investment of roughly about 1,500 crores over the next 3 to 4 years, which we will be able to fund internally. We would not need any borrowings for meeting our capital expenditure requirements.
Right. And overall, from a customer acquisition perspective, how is that trend panning out?
So on the customer acquisition, the good news is that, during the pandemic year and even prior to that, we added about 12,000 members. We have already crossed that mark in the 3 quarters. So you can already see that there is the 4th quarter will truly be the one that will add to the YOY growth for the full year level. So we are tracking very well on member additions. Our member additions are back on track. And also, as you know, that we added a few products in the last 3-4 years, more so in pandemic. They are doing extremely well. So multi-product portfolio strategy is working out. Higher down payment members is our focus, which is what is leading to our resort incomes growing, because members are spending more. We are getting the right members who would enjoy our proposition. So if I were to look at the member additions going forward, we are gearing up for even higher growth on member additions. Obviously, since we have plans for inventory additions at a brisk pace, we will have to also ensure that the members are also growing at a brisk pace. Currently, our total member base stands at 2.77 lakhs, and out of which 85% are fully paid members.
Right. And apart from that, in terms of the announcements, Kavinder, that have come in the budget, wherein the tax collection at source for overseas tour packages has been increased to 20% from a 5%. How will it impact the industry? Because we've just started to recover after COVID-19.
Yeah. So, yeah, industry has obviously looked at this tax as more a cash flow issue. This is not a permanent cost because you can claim refund in your income tax returns. So, really speaking, it's not a cost. It's a cash flow issue for the customer. In our business, since we are largely domestic business, because we have about out of 86 resorts that we have, 74 are domestic, and our 12 resorts are closer to India in terms of Southeast Asia, presence in Southeast Asia. So we do not see any impact of that on our business. Of course, it could have a positive impact, because if people decide not to travel abroad because of this tax, which in my opinion is a cash flow issue, it's not really a cost. But if some people choose to avoid international travel, it should definitely help our business, because we are largely currently a domestic play, apart from the fact that we have a very significant operation outside of India, which is actually self-sustaining and not dependent on Indians traveling to Finland.
Right. So overall, that's the view coming in. Thank you, Kavinder, so much for joining us on the show and sharing those details. Thank you. Stay safe and speak to you soon again.
Thank you.